Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. On today's episode, one day after President Trump saying that he would like to see a buyer for Spirit, his administration reportedly nears a rescue package for the troubled airline. The plan could leave the U.S. owning up to 90% of it. Also, Bloomberg reporting a potential combination between Deutsche Telekom and T-Mobile US that would create the world's biggest phone company and set a record for public M&A. And coming up, we're also going to talk credit with Jonathan Lewinsohn, managing partner and co-founder of Diameter Capital, as he looks for dislocations in the market. And we start with airlines. Spirit said to be working with the Trump administration on a $500 million rescue package. It would give the U.S. government the option to own as much as 90% of the carrier once it emerges from bankruptcy. Rising fuel prices seem to have affected its original plan to exit bankruptcy this summer. This morning, United CEO Scott Kirby spoke to Surveillance's Lisa Abramowitz, and he had strong words for Spirit's business model.
The problems at Spirit predate the run-up in fuel. This was a fundamentally flawed business model that I've been on there, going back into the last administration, saying it's going to fail because the business model doesn't work. And so I think the spike in fuel prices just moves it forward by a couple of months.
Bloomberg's Sid Phillip covers airlines and has been all over this story this morning. So, Sid, does this basically remove off the table for a buyer for M&A to happen? Is it all just the U.S. government involved now?
At the moment, there's multiple options. I mean, obviously, this is one of the options that's available to Spirit, but it does seem to be the best lifeline for the airline if the government actually gets involved and offers them some $500 million in exchange for equity. And it will also sort of put off other suitors. Like we previously heard that Spirit was in talks with Frontier Airlines. Remember, the JetBlue deal was scuttled. So there's been lots of action for Spirit, and this is the sort of latest in development in that story, and this could be the potential sort of help that they could get.
Just quickly, Sid, I mean, it also seems that deals are being floated and batted down. United American, very concretely, it seems that the Trump administration is not happy with the idea, neither is American.
Yes, American Airlines said that they're not interested in a deal and would be anti-competitive, but Scott Kirby has talked about his ambition to make it the U.S. carrier, United Airlines, a very competitive airline internationally, and he sort of talked about how there needs to be an airline that can compete with the Middle Eastern carriers and others who have much larger financial backers. And so Scott Kirby is entertaining the idea of creating this mega airline in the U.S., and he did talk about the fact that they have sort of reached out to suitors about potential assets. So it still remains to be seen. Lots of action happening in the airline front. Sure. There's lots happening on just how the airlines sort of navigate this turmoil, as well as navigate expanding under this administration that's business friendly.
I'm sure we will have you back on for weeks to come, Sid. Thank you so much. That's Bloomberg's Sid Phillips. And this, of course, is not the first time the U.S. has gotten involved with corporate America. And the Trump administration in particular has taken a more aggressive approach. Let's bring in Scarlett Fu, who has more. Hey, Scarlett.
Hi, Danny. Yeah, that's right. Under the Trump administration, the government has begun to take minority stakes in a handful of strategic industries, from semiconductors to critical minerals. The splashiest investment to date is Intel. Last year, the government converted some $9 billion of subsidies awarded during the Biden administration into equity, leaving Uncle Sam as the chipmaker's third largest shareholder. Also last year, the Pentagon backed a group of minerals companies, including Lithium Americas, MP Materials, and Trilogy Metals, and it now owns equity stakes in them ranging from 5 to up to 15%. Now, as you mentioned, we've seen the U.S. take ownership stakes before in General Motors, in Citigroup, and AIG during the Great Financial Crisis. But those were temporary defensive bailouts. This time around, the investments reflect a broader shift in industrial policy aimed at reducing reliance on China while strengthening domestic supply chains, which makes this potential government rescue package for Spirit, which reportedly involves the U.S. government having the option to own as much as 90% of the carrier, a bit of a return to the old days. Danny?
Scarlett, thank you so much. And just on that note, we are going to be talking to an executive tied to the U.S. government later this hour. Barbara Humpton, CEO of USA Rare Earths, is going to be joining me after a deal of her own. But first, let's look at other deal making that the team has been reporting on. Among that, Deutsche Telekom said to be discussing a potential combination with T-Mobile, which already holds a 53% stake in. And that would create the world's biggest phone company. Bloomberg Deals reporter Michelle Davis has been covering the story. We're also going to talk SpaceX and Cursor. Bloomberg tech anchor Ed Ludlow joins us with an update on that. Michelle, first off, fantastic reporting. I mean, this would be mega. What is the thought between putting these companies back together after they already once owned each other and then narrowed that down to just 53%?
I mean, as you said, it would be mega. It would set so many records, not only creating the biggest phone company, but also being the biggest public M&A deal of all time. Essentially, Deutsche Telekom already controls T-Mobile with a 53% stake, but this is really about crystallizing their ownership. Right now, the way the two shares trade, there's a bit of a discount or a gap in valuation. And so the thought is, if you combine them, maybe it removes some of that discount and gets rid of the dual structure. The big question, though, is what does the German state think about this deal? They hold 28% of Deutsche Telekom, and through that are able to kind of influence T-Mobile. If this deal were to happen, they'd be a much smaller investor in a much larger company. So that is what we'll be trying to figure out from here.
And then, Ed, when it comes to Elon Musk's deal with Cursor, it could be worth $60 billion, it could just be a $10 billion breakup fee. What are the details?
Yeah, this isn't straightforward, is it? They have the right to acquire Cursor for $60 billion or a $60 billion value, but the right to delayed till later this year, right? And the thing that you need to know is Bloomberg reported first week of April, we did it on this program, SpaceX has filed confidentially for an IPO. So that's complicated, right? You know, if we are right that SpaceX's S1 went in on that first week of April, they're in the feedback period where the SEC is looking at it, will literally give feedback. A deal of that scale, that would be material to the financials of that combined SpaceX XAI entity. So I'd also throw in that what happened Friday, Bloomberg reported that Cursor was in talks to raise funds at a $50 billion valuation, and there are lots of people impacted here. NVIDIA is an investor in Cursor, also one of the biggest users of Cursor internally, and some of the big venture firms as well. So interesting, it's kind of like we will do this deal, and on the breakup fee, $10 billion, I mean, the other big academic debate is Cursor's tech worth paying $10 billion for as licensing. We'll see.
Yeah, and to make an IPO as if it wasn't big enough, make it even bigger with Cursor in hand. Ed, thank you very much for joining, and Michelle as well, Michelle Davis and Ed Ludlow. Coming up, we're going to check in with Diameter Capital co-founder and managing partner Jonathan Lewinsohn as he looks for dislocation in credit markets and opportunities there. That's coming up next right here on Bloomberg Deals. Time for an alternative view, where we get a perspective from an alternative asset manager. Back in November, Diameter Capital Partners announced it raised $4.5 billion for its fund, aiming to seize on market dislocations. Jonathan Lewinsohn is managing partner and co-founder of Diameter, which manages $29 billion, and he joins us now. Jonathan, thanks so much for stopping by.
Thanks for having me.
So that was at the end of last year, and it certainly feels like there are dislocations out there. Where are you finding the most compelling opportunities? What is dislocated right now?
Well, thanks for having me. I thought the U.S. Constitution required that you start with a question on private credit.
We'll get there, I promise you.
Sure, we'll get there. Look, I think the question is, what is there to do in credit and what are dislocations?
Sure.
And so everyone is always looking in credit for a recession. Credit guys famously call kind of 9 out of every 3 recessions. We're obsessed with it, and usually wrong. The opportunity set for most of my career in credit in dislocations has not been recessions, has been what we call microcycles. And whether it was Meredith Whitney blowing up the muni market after the financial crisis, the oil and gas in 15-16, California power, when you have industries that have debt and either have technological transformation or policy volatility, you get microcycles. And I don't have to watch Bloomberg TV all day, though I do, to know that there is a lot of policy volatility and a lot of technical transformation. And so where do we see it? We see it in places like Telecom, which used to be so boring, and they just raise price. And then all of a sudden there's competition. You have fiber, you have fixed wireless, you have low orbit satellites, things like Starlink competing. And so nearly every global telecom and cable company has some kind of dislocation. We've been investing in that for a while. You have housing. Americans went crazy in housing when rates were low. everyone moved to refinance their mortgage. We went from 5.5 million homes sold every year to 4. 4 seems too low, but it's been too low for a while, and you have a lot of LBOs that have kind of interesting availability. And then you have sectors that, like packaging. Who would have ever thought packaging gets dislocated? But packaging is, but it's hard to know when it comes back because habits are changing. And then obviously software, which is threatening what could be kind of the granddaddy of them all in terms of dislocations.
For software specifically, how do you make sure when you're jumping in that it's not a value trap, that it's not being sold for a reason because AI is going to disrupt the whole thing? Is there actually value out there to be had?
This is the big question. We're all kind of using Claude Code or other things to create dashboards that talk about moat and talk about threat perception, and everyone's got their own fancy dashboards. We're just trying to do what we always do, which is credit analytics and forecast businesses. It's just hard because we really don't know exactly how AI will develop. I think an analogy is helpful. So if you go back, they put a lot of makeup on me, so this will surprise you, but I was around in the 90s as a human being.
Perfect skin, Jonathan.
Thank you. It's nice to say. And they did a great job back then. But in the 90s, when the internet was starting, there were questions about what is it going to disrupt. And I remember that there was a number you could call for the weather, called Call the Weather. I was not allowed to use it. It was close to like being as forbidden as a mini bar in a hotel room. So you had to pay for it. And if you needed weather between, say, the morning paper and the evening news, you paid $2.99 for it. You didn't need to be a financial analyst in 1997 to know that Call the Weather was toast due to the internet. It was gone, and I'm sure it wasn't LBO'd, but it disappeared or shriveled.
Sure.
There was a bigger debate over whether people would buy clothing online. That actually took, we didn't know the word brick and mortar then.
Right.
Will people want to try on pants in a store or at home? And that really took until, even you could argue COVID, for that debate really to be understood. And so if you now then say, hey, how does that apply to today? If you are using Claude Code or other products to build dashboards, and then thinking about, hey, I have a software company that does data visualization, they're probably Call the Weather.
Yes.
Right? If you have a company that's doing, let's say, data standardization or workflow optimization, maybe they have a problem. If you have businesses in areas, let's say security, and we know that Mythos and others are going to upend that, they will be disrupted.
Right.
Who knows exactly how? And that's like buying pants in the store.
Right.
We'll see.
But with all of this, and I think back to an interview you gave roughly about a year ago with Sonali Basak, where you basically said the reason that private credit is looking better than other private credits is just because they're not marked to market, and a reckoning has to happen. Given all of the software fears, given everything you're talking about, has that reckoning happened yet?
Well, it's certainly, there's a reckoning threatening. How's that?
Sure.
And I think obviously people are trying to withdraw money where they can from private credit, and that's created something. And if you look at kind of what's gone on in the last 3 or 4 months as people have tried to get money out of private credit funds, it's reminiscent of what you've seen in other kind of bank runs, in the sense that people wanted to get out of Lehman before you needed to know what the real estate assets were worth. People wanted to get out of Silicon Valley Bank before you knew whether the mortgages and treasuries were correctly marked. People want to get out of private credit before they can know the answer to these software questions we're talking about. The problem is private credit generally does not have an asset liabilities mismatch. We're seeing an opportunity to buy loans that are being sold, but it's not a torrent. It's not the type of run that you get with a bank that doesn't have a gate. And the bigger issue is that private credit, which is a fine asset class, and by the way, very, very big. There's many different types of private credit. I'm old enough to remember when we were talking about companies like First Brands and asset-backed finance for private credit, which is very different than the loans to software companies. But in direct lending, what you saw was an industry that grew into where banks kind of moved back. So after the financial crisis, banks couldn't do loans that were highly levered. And what were highly levered loans? Software. So a bank would look at a software loan and say, this is 8 times levered, it's too much. A private credit firm would say, wow, 95% retention, 80% gross margins, let's do this. And so that and the ability or the desire to not have cyclical assets and to say, hey, private credit is not that cyclical, we don't worry about a recession, created a situation in private credit where many funds didn't do the type of portfolio construction and diversification that you would kind of need in any type of investment product. And that's unfortunate because private credit has capped returns. In private equity, which let's say has 18% in software, at least you're making 20%. If you have a private credit fund that's say 35% software, because all you were doing was doing software loans and other asset light, and all you can earn once it's at par is the coupon, that is an asymmetry between diversification and return, and that I think is the reckoning that is threatening to happen.
So what does that reckoning actually look like? And we're just about out of time, but when we sort of get to that point where funds have to face this, maybe loans come due, what happens? What is the end result of this?
You're going to have dispersion of returns in private credit, which has never happened before, and firms that did a lot of diversification, portfolio management, monitoring, construction will be fine. And those that don't will at some point either provide disappointing returns to investors or will have to slowly sell loans.
What do you think is the split between that of like those that actually did due diligence? Are there a lot of like stinkers out there just looming in the market?
Look, obviously, far be it from us to talk about it. I think we're proud of the fact that our private credit BDC is 4% software. I think you'll find many others are 30%, and when you put them through your model, it says really it's 60%. There's a lot of underlying difference in private credit funds. We are seeing some of them needing to sell, but again, they don't need to fire sale. It's slow, just like the development on the asset side, and they're trying to sell performing things because you want to sell things that give you the most money. But I do think what you're going to see is, like in any asset class that grows, what really mattered was, did you hire a manager who was doing portfolio management? And that'll be finally differences in an asset class that for a while, look, there was nothing more boring in the past than a panel on private credit because everyone said the same thing. And all of a sudden, in your business, it's going to be interesting to have different people on.
Yeah, it's somehow become like the spiciest subject in finance. Who would have thought? Hey, Jonathan, we're going to have to leave it there. Thank you so much for joining. Please come back again soon. That's Jonathan Lewinsohn, managing partner and co-founder of Diameter Capital. Coming up, our exclusive interview with Barbara Humpton, CEO of Rare Earths, discussing their latest deal. That's coming up next on Bloomberg Deals.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are rallying, with the S&P 500 hovering near a record high. That comes as traders digest a wave of strong corporate earnings while also keeping a close eye on developments in the Middle East after President Donald Trump extended a ceasefire with Iran. Meanwhile, oil is advancing, with the U.S. and Iran still locked in a standoff over control of the Strait of Hormuz. The two sides failed to come together for a new round of talks. The U.S. is maintaining a naval blockade on ships heading to and from Iran's ports, while Iranian gunboats open fire on vessels near the critical Strait of Hormuz waterway. And in company news, marijuana stocks are soaring. That's after Axios reported that the Trump administration could move to reclassify marijuana as soon as today. That's according to an administration official familiar with the matter. Those are your midday movers. I'm Nora Melinda.
USA Rare Earth is digging into deals. The company agreed to acquire Serra Verde Group, the owner and operator of a Brazilian mine, for $2.8 billion. It's one of the largest deals in rare earths industry. Joining us to discuss is Barbara Humpton, USA Rare Earth CEO. Barbara, thank you so much for stopping by. So first, why Serra Verde? What did you get access to with this deal?
Oh, Serra Verde is a completely unique deposit. It's the only deposit outside of Asia that has access to all four magnetic rare earths. What that means is we get access to the materials that for decades have been controlled by China. The other thing that's unique about this arrangement is that they have just come to an agreement with a special purpose vehicle backed by the U.S. government as well as private investors that assures 100% offtake over a 15-year period with floor prices for all four of those magnetic rare earths.
And I know that this is important for the U.S. government, certainly important for your company too, because China still supplies just so much of the world and the United States rare earth. How much further do we have to go to get anything that looks like independence from China?
Well, we're at the very early innings of this. Really, China set this as an objective decades ago. They declared the Middle East has oil, China has rare earths. And now we've seen how that monopoly has been used for statecraft. And it's important that we just take this game piece off the board. So I'm really thrilled that the Serra Verde Group recognized the opportunity. They saw that as we grow physical AI, as we grow the new technologies the world has today, there would be more demand for these elements. And over a long period, 16 years, they've been investing in the mine Pela Ema in Brazil near the town of Minasu. The team that's down there are experts experts in mining. They've got this incredibly sustainable approach that they're using, and we're ready now to move into scaled up operation. And with that, we're able to begin to break that stranglehold.
So how much of this deal was done with the pipe that came with the government LOI? How important were they in this?
Well, we actually announced our deal that the Department of Commerce intends to invest in USA rare earth. But alongside that, the deal was we must raise private capital.
Right.
And in fact, it's that capital that's fueling our broader ambitions. Now, when the deal closes with the Department of Commerce, we'll be applying that to the domestic production. Round Top Mountain in Sierra Blanca, Texas, our separation facilities right now being demonstrated in Wheat Ridge, Colorado, and magnet making in Stillwater, Oklahoma. So with the balance sheet that we currently have, the strength of that pipe that we've raised, we've been able to engage in this. And together, this is the value proposition. This represents a platform across the entire value chain. Danny, you might have seen that earlier we announced first the acquisition of Less Common Metals.
Yes.
Maybe the weakest link in the chain. But then we announced just recently our investment alongside the French government with Infravia for Carester, a processor of heavy rare earths in the south of France. What we're doing is we're tapping into the best mines that exist anywhere in the world so that we can recreate this value chain and actually grow the platform that will scale.
Say the growth that you've undergone and the deals that you've done has been really incredible to keep track of and watch. So what's next, Barbara? Where else are the kind of missing links in the chain that you want to fill?
Yeah, we know there's more to do. We know there's more to do. There's been a tremendous amount of friction in the value chain. And so we know that there are deposits coming online over time, and we should obviously be mindful of where a partnership with USA Rare Earth could be meaningful. We also know that downstream, there are magnet makers in search of a reliable supply chain so they can achieve their scaling objectives. But the real key is we're going to grow organically in processing, wherever it needs to be matched up with deposits, as well as metal making. Our metal makers in Cheshire, England, are getting ready to start the apprenticeship program that will train folks from Oklahoma and folks from France in the metal making techniques that will unleash that capability.
Wow, wait, are they going to be in the same room, the people from France and Oklahoma? I feel like there might be a little bit of a language and maybe cultural barrier between the two of them.
I think that a single mission unites the entire company.
I love it, Barbara. Thank you so much for joining. Really appreciate your time. That's Barbara Humpton, USA Rare Earth CEO. Coming up next on the show, our investment committee today takes a closer look into tech as Amazon makes a $5 billion investment in Anthropic. That's coming up next. Don't miss that conversation right here on Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Scarlett Fu, who's taking a closer look at deal making in the tech sector this year. Hey, Scarlett.
Hey, Danny. Surprise, surprise, AI is the dominant theme here. The two biggest deals of 2026 across all industries involve AI and SpaceX. Its merger with xAI before the space startup eventually goes public later this year, and last night's deal for Cursor. Sure, the combination with xAI creates a vertically integrated innovation giant possibly worth up to $2 trillion. But analysts say that the real driver for this deal is Elon Musk using SpaceX's cash flow to fund xAI's cash burn of $1 billion a month to build data centers. And as I mentioned, SpaceX said it secured the right to buy AI startup Cursor for $60 billion later this year, or alternatively, paid $10 billion for them to work together, which highlights another theme here, an increasing preference for strategic investments over outright takeovers, such as Amazon injecting another $5 billion into Anthropic with the possibility of investing another $20 billion down the road, as well as NVIDIA sprinkling around some of its cash, putting $2 billion in Marvell Technology and another $2 billion in Nebius. Now, these are partnerships aimed at expanding NVIDIA's AI ecosystem and investing across its AI supply chain. Strategic investments can also be a way to hedge. China's Alibaba and Tencent are reportedly in talks to invest in DeepSeek at a valuation of more than $20 billion. The bigger companies are finding it difficult to monetize their AI capabilities when open source and free to download models like DeepSeek are growing in popularity. Danny?
Scarlett, thank you so much. And that brings us to this week's Investment Committee, where we take you into the boardroom debates in real time on today's IC Tech Deals and our IC members today. Bloomberg Deals reporter Ryan Gold, Rich Mullen, partner and head of M&A at Wilson Sonsini, and Tony Kim, co-president of investment banking at Centerview Partners. Thank you so much for joining. And Tony, let me kick it off with you because, yes, AI, a lot of investments deals getting done, but then there are the nerves in software. Just how uneven is this year shaping up to be in tech M&A?
I'd say quite uneven. I mean, if you look at M&A last year in tech, there were 25 deals over $5 billion. So for tech, that's a good start, but for most sectors, that's an amazing a number of deals. And then you've got this big kickoff here with the AI deals this year. But there's this real dichotomy. I mean, they're actually the same thing, right? You've got everyone investing in growth in AI, and you've got everybody worried about what AI is going to do to the rest of technology. Yeah,
I mean, Rich, it's a good point. You can't have all this like fervor and excitement about AI deals and then at the same time be really excited about software too.
That's true. I mean, software's faced a lot of inflection right now, and a lot of questions and uncertainty, but there's still some really good software companies out there. And in order to get a deal done, there has to be some level of certainty and value expectation from both sides. We're seeing it that hard to do right now because of all the uncertainty. But if a savvy strategic or sponsor is willing to make a bet right now, I think they could find a really good company that will survive all the uncertainty of AI.
How much of this do you think is being driven by, we heard it in the sound at the top there, behind this idea of the art of the possible? We hear about this a lot in M&A in terms of, a business-friendly administration like we have now. How much of this acqui-hire/licensing type transactions that we've seen are being driven by this idea that we don't want to be caught up in 18 to 24-month fights with regulators?
So Rich and I both worked on the Scale AI deal with Meta. I would say, actually, although that is one aspect of it, I think these deals are being driven by what I'll call AI time, right? Like, it's changing every month. You don't know where it's going to be in 3 months. How could you possibly sign up for a deal that could take 18 months to close? It doesn't work for a buyer. It doesn't work for a seller. That's why you're seeing this pivot to all of these, partnership-type transactions, and that really has become more the norm in the AI deals.
Yeah, and there's intense competition right now for AI talent. Very, very intense. Everyone wants to hire the best team so that they can be competitive in the market. And in order to do that and get people working together quickly, business people are saying, what's the right way to do this? The fast food advice would be to just go do M&A, but that's, not everyone wants to eat a combo meal.
Do you think that there's a view now that, as we get sort of into the midterms later this year, and then, you kind of think that there may or may not be a shot clock that's running? Are there people that in boardrooms that are thinking like, okay, now is our time, we have this many months left to get a deal done? Is that how people are thinking, or perhaps not?
I think that's definitely the case broadly across M&A. You've seen larger deals than you've seen in a long time. There are a number of sectors where people are taking that approach. I would say less so in technology. I mean, remember, technology is the industry that's been under antitrust monopoly investigation for a lot of years, so I don't know that that's going to be the catalyst for them.
Because, Rich, I mean, a lot has been said about like the circular financing of all of this, of how interrelated all these companies are. So, like, are the regulators just completely turning a blind eye? Is there any risk there at all?
The antitrust laws are set up to regulate particular types of transactions, and these types of investments are not the things that traditionally get picked up by antitrust laws. The regulators are looking at these transactions. I think every big acqui-hire type transaction that you were referring to has been looked at by the government at some point. But at this point, the way the laws are set up, there's just no real way for them to come in and enforce it if a deal is structured in the way to achieve business objectives at the end of the day, not necessarily to avoid a regulatory scrutiny.
I mean, presumably that we're talking about American law. I mean, what about the risk internationally, Tony? It's something that the Europeans constantly look at.
Yeah, I mean, absolutely. These actually, we don't call them acqui anything because they're not M&A deals, but they do kind of feel that way. We call them lift transactions. I don't need to get into it, but the various jurisdictions around the world have come out and said, hey, this looks like an M&A deal. I'm going to look at it more closely. The U.S. has done that most recently with the Grok deal. So it is something folks are taking a very close look at. However, actually, like if you look at the components of these deals, they are not actually antitrust reportable. It's just sort of like the looks like a duck, quacks like a duck kind of, element.
Going back and taking a step back and thinking about some of the pain that we've seen so far this year in software, I mean, it strikes me that we haven't really seen a quote-unquote traditional software M&A deal print so far this year. I mean, as you think about it, what might software have entail as far as M&A is concerned once the 3 mega IPOs perhaps are out of the way this year? Will there be a re-rating in the sector? What's your take on that?
Sure. Yeah. So look, I think that what's obviously a dynamic time in software and troubled time for M&A. And the way I like to say it is, the sine wave of what's going on in the market is definitely, too volatile. But there's a through line there that is probably accurate in some way. And everyone's just sort of thought, maybe it's 10 years and then is it 5 years? I'm like, oh my gosh, is it today, right? And so when people can't underwrite that long term, it's really hard to see buyers and sellers coming together. So there's got to be some stability. We're seeing a little bit of that. I mean, I think it's actually, the world seems to be thinking it's accruing to the benefit of the AI companies. But eventually here, we're going to get that through line and then people will start to transact.
Yeah, and software companies are making huge investments into AI as well. So over time, throughout the course of the year, next year, I think you'll see a lot of good software companies that have developed their own internal AI products that, they already have customer confidence. They have a gold mine of data and the expertise in critical areas like accounting and tax and security. These areas that I think require such a high degree of accuracy and certainty that once the software companies develop their own competitive AI product, probably going to get a lot of traction.
And as you guys think about going into boardrooms and talking to CEOs and management teams around, who their likely buyers would be, how do you guys think about, private equity in general? Are they leaning in? Are they leaning out of tech? Because we've seen so many headlines, particularly around private credit. People may be pulling back a touch.
Private equity is looking at a lot of companies, and they're having some of the squeamishness that Tony was referring to. Looking to see what the long-term vision is going to be. Is the terminal value really going to be zero, like people might be afraid of, or is it going to be something different? And I think they'll keep doing their homework, and probably we'll see some deals in the later half of the year, would be my guess.
Yeah, I mean, look, there's probably no group, in the whole ecosystem that has more of a vested interest in figuring this out, and so they're hard at work, and I wouldn't count them out.
And we started this with Scarlett just pointing out that the deals that we have been very large in size. So I think it's fair to say that volume has already started off to a really large degree. I would love to just wrap it up with your crystal ball, your expectations for the rest of 2026, not just the big deals, the big IPOs, but what this year actually shapes up to look like in sort of the amount of deals that get done. Sorry, not the value, but the volume of deals that goes down. Tony, if you want to kick us off.
Sure. Look, there's overall in M&A, there's the whole what's going on in the Middle East, and there has been some static there. There's been this trend towards larger deals, sort of regulatory aspects to them. In tech, I think that there's a lot of stars aligning around what is your AI strategy, right? Some of that's internally developed, as Rich is saying. Some of it's going to be acquisitions. There's this gap, this gulf between buyer and seller expectations. That's on the more traditional software side and on the AI side. But I think you're seeing some softening on both of those elements. So I do think that there's going to be quite a lot of stuff. I do also really, really believe that these non-traditional structures are going to be prominent in AI.
Rich, you see the same thing, the gap starting to close?
Yeah, I mean, completely. The volume in tech M&A is always very high. And it's not necessarily the types of deals that you all would report on here at Bloomberg, but the backbone of technology M&A going back to the 90s has been the acquisition of VC-backed companies, private companies, and it might be a $500 million deal, it might be a $250 million deal, but companies are going to be looking at those types of acquisitions, and the volume is very, very high. I think I'm working on probably 10 of those right now.
See, I'm unaware of any deal that happens unless Ryan reports on it. That's the only way I learned. Thank you all.
Gotta call me more.
He's the best. Thank you all so much for joining. Really appreciate your time. That's today's Investment Committee. Bloomberg Deals reporter Ryan Gould, Rich Mullen with Sonsini, and Tony Kim from Centerview Partners. Up next, activist investors are out in full force, and Goldman Sachs said the momentum is here to stay. Mehrotra, the firm's co-head of America's M&A and global head of Activism and Defense, Takeover Defense, will join us next with his outlook. And earlier this week, QXO CEO Brad Jacobs discussed his current strategy for M&A.
We're looking at every aspect of building products. And there's no part of building products that's off the table for us. And our approach to M&A, Romain, is we look at a lot of things at the same time. We move them all forward and go through the funnel, and we see what makes it to the finish line.
We're
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are climbing, with the S&P 500 hovering near a record high. That comes as traders digest a wave of strong corporate earnings, while also keeping a close eye on developments in the Middle East, after President Donald Trump extended a ceasefire with Iran. Meanwhile, oil is advancing, with the U.S. and Iran still locked in a standoff over control of the Strait of Hormuz. The two sides failed to come together for a new round of talks. The U.S. is maintaining a naval blockade on ships heading to and from Iran's ports, while Iranian gunboats open fire on vessels near the critical Strait of Hormuz waterway. Elsewhere, Bitcoin is pushing higher alongside shares of Robinhood and Coinbase, as easing geopolitical tensions boost risk appetite across markets. That's helping drive renewed momentum in crypto, with investors rotating back into higher risk assets as volatility expectations cool. And we're just learning from Bloomberg News that the U.S. is expected to ease cannabis restrictions as soon as today. Marijuana-related stocks are soaring on these headlines. The Trump administration would reschedule cannabis to Category 3. Those are your midday movers. I'm Nora Melinda.
And the Trump administration missed a trick. Obviously, you ease cannabis restrictions on 420. Anyway, welcome back to Bloomberg Deals. I'm Danny Berger. Let's talk about something completely different. Activist investors are having a moment, and Goldman Sachs does not see the momentum fading. The firm sees three key catalysts: M&A, the push for portfolio simplification, and scrutiny around how some of the market's largest companies allocate their capital. A very notable person in this space is Avi Mehrotra, co-head of America's M&A and global head of Activism and Takeover Defense at Goldman Sachs. And he joins us now for Premium Players. Avi, thank you so much for joining. And we'll get into broader M&A in a moment, but I think this is so interesting because you've obviously been incredibly busy with activism. But I know one of the points that you've made is that, yes, they're busy, but they're less willing to run proxy fights. Why is that the mix?
You know, I think there's a recognition on both sides, on the side of the company and on the side of the activists. The proxy fights are long, they're expensive, they're hugely distracting. And actually, if you're an investor in a company, you ultimately, as an activist, still want that company to do well. You don't want them to be distracted by a multi-month proxy fight. So I think also companies are looking at this and saying, if I can push back, if I can get to a good outcome, and I can do it in the way of a settlement as opposed to going through a 3 or 4 month journey through a proxy fight, that may be better for me. And so it's all a question of, can you get to the right outcome? Because sometimes the activist ideas are really about accelerating a time frame. It's maybe about stretching the balance sheet. But if we can get to the right answer on those things without compromising the forward trajectory of the company, I do think companies are looking for the right off-ramp in the right situations.
Have you been advising them to find that line of, yes, acknowledging the activists, maybe moving forward some of those things, but not a complete cave-in to what their demands are?
So it's a great question. I think the way to think about this is that the activist is just one investor. It's one investor. It may be a loud investor. They may have a point of view. But there are other shareholders that have collectively a much larger and a louder point of view. And so we encourage our clients to really tap into that, because if you're getting support from a broader group of your supporters and your shareholders, actually gives you the mandate and gives you the license and it gives you the platform to push back on the activists far more aggressively. And I think companies have started to find that right balance, and that's why I think you're seeing a little bit more of these détente type situations as opposed to a full-blown, knock them, drag them out proxy fight.
Well, what do you make of the campaigns, Ackman and Univision, Irenic and Snap, where there is a controlling shareholder in these companies? So by definition, the amount of push you can have is quite limited. Are these just a campaign via publicity, I guess? What's the play?
It's a good question. I think that when you have a controlling shareholder and an activist comes in trying to oppose a controlling shareholder, it's a tough call for the activists. I actually think it puts a company in a strong position. And we remind companies that even if you don't have a controlling shareholder, if you can get the support of enough shareholders, it can actually create almost like a synthetic block in much the same way. And so, our view is, stand your ground, check with your other shareholders. The activist is simply one voice.
So, Avi, you spend a lot of your time talking to CEOs, a lot of time in boardrooms. So there's been a lot of activism, a lot of M&A as well. What is the general sense that you're getting from corporate America at this point?
So, it's interesting. We're coming off of a very strong Q1 around M&A activity, but it's really
I think one of the best first quarters ever, right?
Yeah, absolutely. But it's really a continuation of a really strong Q3 and Q4 from last year. So we're in this now several quarter period of time where we're seeing incredible ambition in the boardroom. I think the nature of that ambition comes from the fact that there's a recognition that scaling up and having size may be a competitive advantage, right? Said another way, being subscale could be a detriment. And so I think companies are looking for ways to do that. You've also got very healthy financing markets, which allow you to dream big and to execute big deals. And these financing markets are not just, very well functioning, they're incredibly deep. The cost of capital is, even before any interest rate cuts that we may have later this year, the cost of capital is still quite attractive. And the credit spreads at which you're financing at are near all-time tights. And so the financing market, the ambition in the boardroom, the scale and the search for scale and the competitive advantage that can provide, I think it creates a good brew for the M&A momentum to continue.
Is that true? We were just having a conversation about tech M&A, and I wonder, those financing markets being open, how equally distributed is that? If you're a software company trying to tap the financing market, do you find the same success?
I think the financing markets are very discriminating, and some sectors are up, some sectors are down. And even within sectors, you've got winners and losers. And you can have, within a given sector, companies that are trading at attractive valuations, companies that are trading at more lagging valuations. So I think you have to just know where you stand. And this gets back to kind of like, finding your moment. And if you're in a strong position, capitalizing on it, and doing so, at a moment where you might be the first mover advantage.
One of the things I know you also write about of what's fueling M&A is AI and some of the tailwinds from that. But this is something, you can't necessarily tap an executive or bring someone in that has decades of experience, just given how new this is.
Yeah.
So are we all kind of flying blind? Are we putting the plane together as we're flying it? How have you been advising your clients when this might be a motivating factor for M&A?
So I think the way we break it down is, if you think about what AI is going to do for companies, it's going to provide competitive advantages. It has the potential to be hugely disruptive to certain industries. It also has the potential to change the cost curve of certain industries. So you want to invest in AI and make sure you're doing that ahead of your competitors and making sure you're staying in front of them. At the same time, you want to make sure your business is AI-proof, right? A lot of what's happening in some of these sectors that are selling off and valuations that are coming down is that there is a recognition amongst investors that maybe AI poses a huge threat to your business. And so I think you've got to look at both sides of AI, capitalizing on it, using it for efficiencies and productivity, and at the same time making sure your investors and your constituents understand that your business is actually defensible against an AI onslaught.
By the way, I think there are a lot of folks who expected M&A to slow down on the onset of the war in Iran, and part of that was higher energy prices, the concern about what that means for pricing. Just quickly here, Avi, is there a scenario where if we do get a prolonged energy shock to the system that it could slow down M&A, or do you think we go full steam ahead regardless?
Look, I think that these are all tailwinds right now, but you've got to look at it from the standpoint of if this is prolonged, as you mentioned, I think this can change relatively quickly. I think we need to be very sanguine about the fact that right now, the impact to the U.S. economy, the impact to inflation has been modest. But the longer this goes on, I think those can turn into more significant headwinds, and I think they can affect M&A, but they'll do that by affecting the tone in the boardroom, right? That people will look at this and say, if I don't have as much visibility on where my business is going standalone, then the idea of a combination or doing something material is something that maybe I'll put on hold.
All right, Avi, thank you so much for joining. Really appreciate your time. Great to have you. Avi Mehrotra, co-head of America's M&A and global head of Activism and Takeover Defense at Goldman Sachs. Coming up, we talk the Jersey Mike's IPO. That's up next on Bloomberg Deals. You're watching Bloomberg Deals with Danny Berger and Scarlett Fu. Backed by Blackstone, Jersey Mike's, the sandwich chain with more than 3,000 locations, submitted a confidential filing for its IPO. Here to discuss is Bloomberg's Anthony Hughes. Anthony, it's not a flashy tech IPO, but it feels like Jersey Mike's has some real momentum to come public soon.
Yeah, well, it filed confidentially last week, so we've had quite a few of those companies file confidentially and publicly recently, and this is really setting up for maybe coming in potentially July, but maybe after Labor Day, it depends.
Correct me if I'm wrong, but that seems really soon, given that Blackstone just bought the majority stake in early 2025.
Yeah, sometimes we see private equity firms sell company, take companies public after a long hold period, and other times when it's quick. And usually, if it's quick, it's either because the market's really hot, or the business is doing really well.
I mean, you want to keep Danny DeVito as your spokesperson, right? Like, that's a good reason as any for Blackstone to, like, keep a little chunk of Jersey Mike's. Hey, Anthony, thank you so much for stopping by. We'll have to have you back when the IPO comes. That is Anthony Hughes. And that does it for Bloomberg Deals from Scarlett and myself. And stay up to speed even after the show. Subscribe to the Bloomberg Deals newsletter. Our fantastic team walks you through all the latest action in financing and M&A. Up next, it's Balance of Power live from Washington. You're watching Bloomberg.